Two people walk into the same bank, take out the exact same $100,000 loan at the exact same interest rate. Yet a few years later, one of them is drowning under debt payments, while the other has built a multi-million-dollar portfolio using that exact same capital. So, what actually changed? The first person bought liabilities that constantly drained cash from their pocket. The second person leveraged that debt to acquire an asset designed to generate cash flow and appreciate over time. Here's the truth most people miss. Debt isn't inherently bad or good. It's simply a financial amplifier. But before we analyze the 5 strategic ways wealthy investors leverage debt, we have to answer one critical question. What turns ordinary debt into a wealth-building tool? And where does it cross the line into a catastrophic trap? Chapter 1. The Cash Flow Engine. Imagine 2 people, each taking out a $50,000 loan today. The first person buys a brand new luxury vehicle. The second person buys essential equipment for their growing business. On paper, they carry the exact same liability. But structurally, these loans are working in opposite directions. The car triggers immediate monthly payments while depreciating every single day. The business equipment, however, increases operational capacity, allowing the business to serve more clients and scale revenue. It holds an advantage the car never will, a built-in mechanism to help carry its own debt. This distinction defines how strategic investors evaluate leverage. Before borrowing, they don't just ask if they can afford the payment. They ask, what reliable cash flow will this capital actually produce? The exact same model applies to commercial or rental real estate. A mortgage is a binding liability, but when structured correctly, monthly tenant rents cover the mortgage, property taxes, insurance, and maintenance, leaving a net margin of positive cash flow while equity builds in the background. However, calling an asset an investment doesn't eliminate risk. Vacancies happen, revenue fluctuates, interest rates shift. A single oversight in market analysis can transform expected cash flow into an out-of-pocket expense. The real lesson isn't just borrowing to buy assets. It's ensuring the asset maintains a sufficient safety margin to support that debt even when market conditions deteriorate. And that leads directly to strategy number 2. Because surprisingly, wealthy investors often borrow even when they have millions sitting in liquid cash. Chapter 2. Liquidity and capital preservation. Now this is where capital management gets interesting. Picture having $300,000 in cash and identifying a prime income-producing asset. The instinctive move is simple. Pay 100% cash, eliminate interest, and own it outright. In certain high-rate environments, that may well be the right call. But a seasoned investor looks at that $300,000 through the lens of opportunity cost, which simply means, what else could that same money be earning if it wasn't locked up here? Instead of asking, can I pay cash for this? They ask, if I lock up all my liquidity into this single asset, how does that impact my overall financial position? Deploying $300,000 cash erases debt, but it also depletes liquid reserves. If a market downturn occurs, a major emergency arises, or a superior investment opportunity appears, that capital is tied up in illiquid equity. So investors often choose a balanced approach. Put down a fraction in cash, finance the rest on manageable terms, and maintain substantial capital in reserve. Now their money serves multiple strategic roles. One portion controls a cash-flowing asset, another sits as a safety buffer, and the rest remains liquid for high upside opportunities. But there is a sharp double edge to this strategy. Holding cash while carrying debt only makes sense if the yield, safety, and flexibility of that cash outweigh the cost of the interest. If you borrow at high rates and let your cash sit idle without a clear purpose, you aren't optimizing wealth, you're simply accumulating unnecessary interest expense. Wealthy investors value liquidity, but never blindly. Every dollar must have an assigned job. And in the smartest applications of this strategy, the asset itself ends up servicing the debt used to acquire it. Chapter 3. Self-liquidating assets and margin of safety. This is where leverage shifts from an added expense to a structured tool. Consider a manufacturing company operating at maximum capacity, producing 1,000 units a week, but facing demand for 1,500. The owner faces a choice: turn down profitable demand or finance modern machinery to expand output. The core metric isn't just loan approval. It's the net cash margin, or in simple terms, the exact profit left in your pocket after every single loan payment and expense is paid. If the new equipment generates $8,000 in additional net revenue, while total debt service, maintenance, and overhead cost $5,000, the asset is effectively servicing its own financing while adding $3,000 to the bottom line every single month. Yet, if key assumptions shift, the equation changes rapidly. If sales contract, maintenance costs spike, or equipment sits idle, that fixed loan payment remains unchanged. What was projected as a productive asset quickly becomes a heavy liability. Real estate operates on the exact same financial reality. Seeing $3,000 in gross monthly rent means little until you calculate vacancies, management fees, property taxes, structural reserves, and fluctuating interest costs. Gross revenue is a vanity metric. Net cash flow is reality. This is why experienced investors don't just look for profit, they build a margin of safety. Think of it as a financial cushion built to absorb bad months, economic crashes, or unexpected repairs without breaking your business. They demand enough operational buffer to absorb economic shocks, lower occupancies, and rising costs without endangering the asset. And once wealthy investors accumulate these high-value, resilient assets, they unlock a financing strategy that avoids selling them altogether. Chapter 4. Liquidity without liquidation. Imagine owning an asset portfolio that has appreciated significantly over a decade, and you suddenly require substantial capital. The conventional path is to sell a portion of the asset, but high net worth investors often evaluate another path first. Can I access liquidity without triggering a taxable event or surrendering ownership? Depending on their portfolio, investors can borrow money using their investments, such as real estate, private equity, or diversified stock portfolios as collateral. This is known as a securities-backed line of credit. In short, using the value of your stocks or properties as security to get cash, without selling them. The potential advantage is clear. Selling an asset relinquishes future compounding growth and typically triggers capital gains taxes. Borrowing against eligible collateral provides liquid funds while allowing the underlying portfolio to remain intact. However, this strategy carries distinct operational risks. Leverage against volatile assets during a market downturn can be extremely dangerous. If collateral values decline significantly below contractual thresholds, lenders may issue a margin call requiring immediate additional capital, or forcing the liquidation of assets at depressed prices to satisfy the debt. Rising interest rates can also increase debt servicing costs, compounding losses on a declining portfolio. Asset-backed borrowing isn't free money or a guaranteed shortcut. It's a sophisticated liquidity tool that requires strict risk controls and deep market awareness. Which brings us to the fundamental difference in how debt is accessed across different wealth levels. Chapter 5. The True Advantage. Borrowing Power. Here is the core distinction that redefines the entire conversation. Wealthy investors don't possess a secret, magical form of borrowing. Their advantage lies in a fundamental concept: borrowing power. Consider two individuals requesting the same $100,000 loan. Borrower A has fluctuating income, limited liquid reserves, and a weaker credit history. Lenders view the transaction as high risk, resulting in elevated interest rates and strict repayment terms that put continuous pressure on their monthly cash flow. Borrower B requests the exact same $100,000, but they present strong credit, verified cash flow, valuable collateral, and substantial liquid reserves. Lenders compete for the business, offering favorable terms and lower interest rates. More importantly, if an investment underperforms, borrower B has a financial cushion to absorb the impact without entering a crisis. Both carry debt, but they carry vastly different levels of structural risk. For anyone building wealth, the takeaway is clear. You don't need to adopt complex leverage strategies before your foundation is ready. Prioritize building your borrowing power first. That means eliminating high-interest consumer debt, strengthening credit profiles, maintaining liquid emergency reserves, and rigorously analyzing risk before taking on liabilities. Because leverage doesn't fix a bad investment, it simply magnifies the final outcome. Used with discipline, debt can provide capital flexibility and help acquire productive assets. Used without sufficient cash flow or a margin of safety, it can turn a manageable financial oversight into a severe setback. Ultimate wealth management isn't about borrowing as much as possible. It's knowing precisely when debt serves a strategic purpose, and when walking away from the loan is the smartest investment you can make.